From Central Indiana's #1 news source, this is Fox 59 Tonight.
And we're back with more Fox 59 tonight. We're talking about your money, Fox Financials tonight, and credit cards. Everybody pretty much has one. Now it's so easy to do. You can just use your phone and scan it and get whatever it is that you want. Of course, it's on the internet. It's on your computer when you buy online at Amazon and so many other things. And so that ease of access, though, comes with some consequences because credit cards are called credit cards for a reason because you have to pay them back. And India Elliott's our financial advisor here. India, it is a thing that literally can ruin your credit history, ruin people's lives. There's nothing worse to me than having a credit card in my pocket, and not being able to use it.
Yeah, credit cards tend to come up when I'm working with clients. They tend to be the top reason that that family is struggling to manage their bills.
Hmm.
And they're great when we're using them and we need them, but then on the other end, we got to pay it back, and it can really throw off your whole financial plan from there.
So first off, you got that minimum payment, and the credit card company loves a good minimum payment because you're just pouring a water bottle on a forest fire, and every time you do that, they make money, right?
That's right. That's right. They're happy. They want you to make the minimum and they're okay with that. The interest rates on credit cards are astronomical. Okay, so whatever you're borrowing on that credit, they are looking forward to you making that minimum payment so they can keep charging that sky high interest rate.
And sometimes that minimum payment uh, is less than the actual interest that you're paying each month. So it's like, go ahead,
Yes.
pay the $200. It's
Yes,
fine.
people don't realize that the interest payment is so high that sometimes by making that minimum payment, you're not even really chipping away at what you owe. You're just simply paying the bank for allowing you to use the credit.
Now, India, a thing that I've noticed, sometimes I'll get, you know, just like anything else, money ebbs and flows. And so sometimes it's like, man, we're doing really good right now. I'm going to put a bunch down on these credit cards. And then I don't use them for a little bit. And then I come back, I'm like, wait a second, I haven't used this card, but I was under $1,000 and now it's back over two.
Hmm.
Explain why that
That
happens.
interest rate got you good. It did what it was designed to do. The bank said, okay, you're going to keep money on this card. We're going to keep charging you that interest. And it's at some point, you're going to have to pay us.
Hmm.
So if you keep money on that card, you keep a balance there, you got to watch it. You got to keep it low, if not at zero.
Hmm. Hmm. And I've gotten there was one card that I literally forgot I had, and I know I got that card down in the hundreds, and I looked back at it one time, I was like, "Forgot I even had this card," and I'm looking through, the bank statement to see was somebody using this card, and nope, it's just the monthly interest on it just ticking back up. I'm like, "Wow."
Man, Cameron, you're not the only one that has gone through that. Credit cards are such a tool for those who are on top of their finances. On top, if you're not a person who looks at their account weekly, who sets money aside for this and puts money aside for that, if you're not that person who checks your accounts, I wouldn't recommend a credit card, at least at this time in life, until you become that type of person, because you really have to be on top of credit cards. They can be a great tool when used properly,
Mhm.
but that's the key. Use it properly.
Now, I've tried to stop using my credit cards when possible, but again, then the consequences if I'm not using it in my mind, it's good. And for them, I have them all set up for minimum payments, but even then, that minimum payment doesn't really knock it down. It pretty much holds it where it's
Mhm.
at. If you're not using it and you got a decent minimum payment number going in there, you're just the number. It never goes up or down, but the bank credit card company continues to make money off of
Mhm.
me doing that. And so I got into the habit of using more of my debit card. And that way, because that's my money and I'm watching it and I just felt like I had a better handle on. I can't spend what I don't have on a debit card. If it's zero, it was zero. And that is until I was the victim more than once of somebody stealing that debit card information. Seemed like it happened both times I went to Bloomington.
Mm.
But I actually went to different places. Nevertheless, is when it happened. And so my bank said, "Well, why aren't you using your credit cards?" I was like, "Because I don't want to, because you charge interest." And they're like, "Well, I'm gonna let you in on a little secret. I mean, the bank, yes, we're gonna give you your money back because it was stolen from you. But the thing is, they were able to take so much from you in that weekend is because you're not looking at it and the bank's not looking at it.
Mm.
It's it takes a little while sometime for them to send you that text and say, "Is this you? Did you just spend $15,000 in Los Angeles?" No, no, because I'm in Indiana, so no, that wasn't me. And so he said, use your credit card more because the credit cards, that's the credit card company's money, and they are watching more to protect their money. They've got, we talked about duty earlier. They got a little more vested interest in making sure that your money's not being stolen.
Hmm. Now, that's an interesting strategy, an interesting way to approach the use of credit cards. I can see that. I can see why they would care more about money being stolen from their pocket versus yours. So that's something to consider. Again, whether you're swiping the credit card or the debit card, ultimately, you got to make sure you have the cash to pay for what you're buying, regardless of which card is used. And hopefully, you bank at a good bank that will help you in a fraudulent situation, regardless of which card was used.
And thankfully mine did. They took care of me, but he was giving me some lessons. He was putting me on game, if you will, on how the credit card versus debit card situation works. So paying your credit card. So we got that monthly payment, that monthly minimum payment. What if I paid that monthly minimum payment twice a month?
Now,
Does that help at all?
now you're cooking.
Okay.
Yeah, that's going to help chip away. Now you're going to actually impact that principal balance of which you owe more, um, above that interest payment. And so there are certain dates, certain ways to time paying your credit card so that you're paying it before the interest hits so that you can chip away at the money that's owed versus only chipping away at the high interest rate that's on that card. So paying it twice a month will likely, well, not likely, it will lower your payment, your balance a lot quicker and efficiently.
So India, why is it that if you miss a payment on something, credit score drops 20 points? But if you pay 6 different credit cards on time and you drop a little extra, your credit score goes up like 3 points. Why is that?
Cameron, that's the $1,000,000 question.
Mm.
I think that's just the society, the world that we're in. It doesn't take much at all to harm, to go down, to fall. But you got to work so hard to do great and be great. I don't know why that is. It's just how it's designed. I guess you just have to prove yourself a lot more on the upside of things. And we are not as trusting when things go south.
So is that a lesson in um the you get punished more than you do rewarded with credit cards?
Yeah, with credit cards, I'd say that's true.
Is it a- and with credit card the idea is you would want, if I pay something, I guess, yeah, we're toward the end of the month. So if I buy something today, when do I need to have that paid off? Before the end of May or before the end of June? Because they always say you wanna pay that off before the month. So is it by statement or is it truly by month?
It's by your statement, whatever that date is, you want to make sure you pay it before your cycle of your
Mhm.
statement.
What if my statement happens to be tomorrow and the cycle starts tomorrow?
And you bought it today.
Mhm.
I don't know. Don't quote me on that. Don't have me giving you wrong information on here. But I'd say if you bought it today and your statement is tomorrow, you shouldn't. You should just use cash today if you plan on, if you have the
Mhm.
cash, just go ahead and use the cash today.
Mhm.
Um, Otherwise, plan for an interest payment to hit. and just knock it out the next month.
And I think usually, because there's always that processing time, sometimes it doesn't even appear until the next day anyway. So I'm going to guess that it would appear on June's statement of what I spent in the past month.
Yeah.
Um, so that's because that's always one that I'm thinking about. Like, okay, we're getting close to the end of the month. That's when you got your bills due.
Mm-hmm.
So you want to try and keep. Um, I think I probably spend more on credit cards toward the end of the month because my debit and bank account is ready for those bills to automatically come out. So it's like I'm gonna not take out of that pot. So instead, I'm gonna use the plastic on this one
Mm.
and then try to get it, caught up on the back end. Does that make sense?
Yeah, and that can be a great strategy. Again, if you're on top of it and you know you're going to pay it off, I love it. Do it. It's just staying on top of it that's so important. You're by using that credit card, you're getting rewards, you're getting perks, you're building your credit. So it's a good tool to use. Again, just use it properly, and it sounds like you are.
Well, I don't know. I think I'm using it. I think I do overall a good job, but the lesson that I've learned is um, how much we're spending by just paying that minimum payment and um, not just go ahead and pay it off. Because the thing is, if you pay it off, it's not like you're losing that money. You get to use it again on the credit card. So
Hmm.
go ahead and you're I don't know. How would you explain what am I doing? How would I explain, I know what I'm doing in my brain, but how do you verbalize that and explain to somebody that if you've got the cash, go ahead and pay off the credit card because uh like I said earlier, there's nothing more frustrating to me that in a time where I've got these credit cards in my pocket, but they would have been, all maxed out.
Hmm.
I can't do anything with it. So it's
Hmm.
pointless.
So, I'd first say ask, why am I using this credit card? Is there a reason that I'm using the credit versus debit? Because if you're using it, let's say to build your credit score, then we typically want to keep your credit usage below 30% at all times. So if that minimum payment is keeping you below that 30%, then it could be an effective way to use that because you're you're trying to space out those payments strategically so that each month it's showing you making on time payments to build your credit. So in that case, that it could be a smart thing to do. But if you already have a great credit score, you're not attempting to build it for something in particular, then there's really no need to maintain a balance and to continue to pay the high interest rate. Just go ahead and knock it out and pay it off. And then if you need to use the credit again in another month or two, go ahead and then pay it back off. The only reason we want to drag it out is if we are using it to build your credit
Mhm.
strategically.
And see, when I do it, when I, because I'm thinking about all the payments and stuff that I'm making, and sometimes it's like, mm, there's 300 left, but $300 left. I'm gonna go ahead and give you 100 this month because the minimum payment was only 50. But especially if I paid twice a month, I could have just knocked that out in half the time. So
Mhm.
that's one of those that cards that end up kind of sneaking up on you, that you think you're paying it, but you're not doing it often enough that the rate just goes back up on you.
Yeah, because that $300, you pay 100 on there, and the next month, well, I owe 299. It's like
Yes.
it's gonna jump right back up to where you were. So in that
Hmm.
case, I'd say just knock it out and be done with it.
Um, is there a uh, fast? So like if I wanted to pay off a credit card quickly that I've been holding, I'm just like, my Discover card. Discover loves me because I got that card back in college, and I always pay it, but I've never knocked a dent into it. What would be the best way to start? Do I focus on one credit card at a time or
Hmm.
try to balance amongst the other and make sure everybody gets, of course, at least a minimum payment because you want to pay it. But if I'm trying to knock them down, do I knock them down one by one or evenly amongst all of them?
Yeah, this is where we strategize. So again, each person's situation is unique, and I would prefer to handle each one individually. But generally speaking, um, I would say look at your highest interest,
Mm.
the one that's charging you the highest interest, and start there, because you're losing the most money on that card. So take the card that's charging you the most and throw as much residual income at it as you can. So make the minimum payment on all of your cards, but throw any extra money that you have toward the highest
Mm.
interest first. Knock that one down. Once it's gone, it's called a snowball effect. You take that same amount of money that you were putting on that card and apply it to card number two with the second highest interest rate. And then we're going to snowball it down. You're not going to pay any less just because you paid off a card. If you're paying $500 a month on 3 credit cards, then once it's down to 2 credit cards, you're still going to pay $500 a month.
Mm.
You're just going to apply it to the 2 credit cards that are left. And what you'll find is that it's going to be super quick to knock out the smaller cards or the cards with the lower interest rates because you're going to be applying more money toward it.
Is there when someone meets with a financial advisor, if people have been listening, like, okay, maybe I do need to meet with a financial advisor, how much of a task or it is a lift do they need to like start gathering all their credit card information and bank statements? Like, how do you even prepare to start talking to a financial advisor?
Yes, gather the statements, your credit card statements, your bank statements, receipts if you need to. Gather any information you can to bring to your advisor so that you can paint the picture of what the situation is. That way we can lay it out and we'll map it out for you and tell you exactly where to go from here.
Do you also need to bring in the retirement information? Is all that a factor? Pay stubs, does all that count as well?
All of that counts. If we're doing a holistic retirement analysis for you or just a holistic financial plan in general, we want to see any statement that has anything to do with money. So let it be a checking account statement, a savings account statement, your 401k or 403b statement, life insurance, especially if you have a cash value type of policy. We want to see pay stubs or any sources of income, Social Security if you're of that age or approaching that age, because we'll run projections on that as well. All of that is necessary. Some people may have annuities. We want to see statements for all of that when we're preparing your financial plan.
So, as you're doing that, you also got to factor in um, rent or your mortgage. And I guess let me ask you. I always hear people say, um, "There's no point in buying a house anymore.
Mm.
I'm just going to rent because the cost of uh, the process of getting a house um, is more work than just paying the rent." Or people say, well, the stuff that you have to pay for, I'm paying for my lawn care to be done and all that with my apartment rent versus you still have to do it with your um, with your mortgage. Is there truth either way of that statement?
There could be. I'm not of the belief that renting is better unless, certain circumstances, like if you're aging and you don't want the maintenance of a house or something like that. But generally speaking, building equity in something that you own and can call your own is better than giving away money each month to something that will never be an asset of yours.
Talk about equity real quick, because that's the thing. That's really the difference. That if if uh, if person one lived in their place for 30 years and they rented it, and person two lived next door in the identical house and they own it, there is a difference.
Hmm.
In person one, it was your place, but you have nothing to show for it, I guess,
Hmm.
financially.
Hmm. So person one, I think that was the buyer, right?
Person one will be renter.
Other the renter.
Okay.
So person one is funding their landlord's
Hmm.
dream. They're buying a house for their landlord, and so they'll walk away from that situation. Let's say they live there 30 years, like a typical mortgage. They've paid rent for 30 years and essentially bought a house for someone else, and they walk away at the end of that deal with nothing. Whereas person two, who was buying that house for 30 years. It may have taken 30 years, but at the end, they own that. So if it's $100,000 house, at the end of it, they've paid for it. And typically, real estate appreciates. It's one of the highest appreciating assets over time. So, um, which end of the stick would you rather be on? Buying a house for someone else or for yourself?
And what when you have equity, what does that mean, or what are you allowed to do with it?
Equity is ownership. Equity means you own a piece of that pie. And so, in the case of a mortgage and buying a house, as you pay on that mortgage, you're gradually gaining equity or ownership in that property because you don't own it up front. When you have a mortgage on it, the bank owns that.
Mm-hmm.
That's a loan that
Mm-hmm.
you're trying to buy from the bank. But as you make your payments, you get a little piece of the equity or
Mm-hmm.
ownership and a little more and a little more and a little more. And the end goal is to own 100% of it.
And that's also um, one of the pieces that I don't think people understand. They think um, that you don't own it until it's completely paid off,
That's right.
and that's not the case. You own it as you pay for it,
That- Yeah, you own a little bit of it.
on a little bit,
A little bit of it. But ultimately, if you don't own all of it, the bank owns it
right?
and they can take it back from you. So,
And then, of course, if there is, um, if you're renting, again, at the end of that, you have nothing to
yeah,
show for it.
you have nothing to show for it if you're renting.
What's the consequences? Because we talked about mortgage a little bit. Um, when you if you're late with mortgages, because and this kind of might be getting off into a little deeper conversation, but you know if you're late on your mortgage, well there is a perk. The mortgage company usually gives you a grace period of
Mm-hmm.
like half the month to
Mm-hmm.
pay,
Mm-hmm.
versus the rents pretty much due the first day. Maybe if you're lucky, you get 2, 3, 5 days
Mm-hmm.
of a grace period. So that's one perk. But there are um, consequences if you are late or miss a payment or you get behind on your mortgage.
Yeah. So, like you said, mortgages typically give you until the 15th before they start charging late fees. Um, and I'm sorry, what was the second part of that question?
And
Just
so, what's um,
like the benefit of
the
that
yes,
grace
the benefit
period.
or the consequence really?
Okay. Well, it can still hit your credit.
The credit.
Your credit, your
Now, do
credit, your
they?
credit.
And I guess that's where I was going. Do they say, okay, you didn't make it by the 15th day, report you to your credit, or do they typically do you get a month, or how does that usually work?
No, you get about a month or two. They give you a little bit longer to make that payment. You'll start getting letters in the mail and phone calls, and they'll try to collect that payment first. But about after 2 months, it's gonna likely hit your credit.
And so at minimum, you never want to get now you will have to pay that late fee, $30, $50, whatever they decide it's going to be.
Hmm.
But again, you still get a little wiggle room before they start reporting you to your credit company.
That's right. That's correct.
Um, we're about out of time, but as we as we've talked, people might want to reach out and find a financial advisor. Maybe it's you. I don't know if you're looking for clients or whatnot, but where can people start to get a little information?
I am accepting clients, at least the right clients for me, and you can find me on Wells Fargo Advisors website, or you can reach me by calling directly. My office line 317 208 3720.
And again, I like that you said which because that shows uh, what your mission is. You said the right client for me, meaning I'm just not taking
That's
everybody.
right.
Because again, your goal, I assume you want people who are teachable and want to listen and who actually want the advice, I would assume.
Yeah, you have to be serious. People who are in a position to be able to make a change in their finances. So if you're in a position where you are willing and able to save and you're ready to be disciplined in that saving and investing, then I can help you. If you're in a position where you have maybe saved for years and now you have a large chunk of change and you don't know what to do with it, or you're unsure of if you've been doing the right thing, then I can likely help you. And that's a conversation we'll have to see if we're aligned in that way. And I also want to say I can be found on LinkedIn as well, India Elliot on LinkedIn.
India Elliot, it has been a pleasure having you. Appreciate all the wealth of knowledge you were able to share with everybody as we all try to spend some money, but save as much money as we can. But also, we want to make as much money as we can, too. It's a delicate balance. And of course, the credit card company wants their piece of it, too. Thank you so much for coming on.
You're welcome. Thank you.
All right, that's going to do it for this edition of Fox 59 tonight. We're back here tomorrow night at 8 o'clock. I'll talk to you on the radio Sunday morning on WTLC and 106.7 for my show, Open Lines, where you'll get to call in and be part of the conversation. More from us here at Fox 59 is coming your way. I'm Cameron Riddle. I'll see you tomorrow night at 8 o'clock.